Next 10 minutes, you own this place.
All right, awesome. All right, so my name is Jamin Armstead. I am a registered investment advisor, independent advisor, owner of J. Deshawn Financial. As Darren mentioned, I'm also host of a podcast, Everything Cha-Ching. One of the reasons why I decided to venture off into my own world, if you will, from an independent standpoint, both on the advisory side and from a podcast host, is, I felt that there was information out there that's missing. No shade on, major financial corporate institutions. My career was, Vanguards and the Merrills of the world, but to me, there's a lot of information out there that's not being shared. And one of those, for example, is with 401ks. We all know years ago, when people would retire, they had pensions. My dad has a pension, my grandfather has a pension. I read the other day, only 16% of Fortune 500 companies now offer a pension. That's almost none, right? So retirement planning now falls on the shoulders of all of us. And I think you mentioned it too, the focus is retirement planning with Transamerica, with your institution, which is great. But the problem is that 401ks don't necessarily come with an advisor, right? And a lot of the major corporations won't focus on 401ks because they can't bring those assets in-house, right? So what I would like to do is be able to take the major portion of what people's retirement is going to be and help them manage that, right? 401ks are kind of limited in the investment options that are available, but my mom, for example, she's an HR manager. She has no idea what she's picking, right? It's like me popping up the hood of my car and, changing my timing belt. It's going to be ugly, right? So one of the things that I wanted to do was, again, be able to provide services that, there's little holes that are out there. So helping people manage their 401k for a very, very minimal cost is something that, I like to try and provide. Another line of thought, which a lot of people aren't aware of, is being able to become mortgage free in 5 to 7 years. Now, how many people here are homeowners? Okay, a lot of homeowners. Has anyone heard of the Mortgage Equity Optimizer? It's a mouthful, but the Mortgage Equity Optimizer strategy, where you take a home equity line of credit, it helps you pay your home off completely in 5 to 7 years. You heard of it?
There's a mortgage guy in another group I go to that's been you can pay your mortgage off in under 10 years.
You know what? I heard about it. I looked into it. First, I didn't believe it, but the more I studied it, even though it's not something I do personally as a line of service, but again, it's information I want to provide, because if it helps you become financially independent, if it helps you and your family, gives you the ability to invest, gives you the ability to enjoy your life, then why give the bank all this money and interest if the tools are out there available to you? So one of the ways that you can utilize the Mortgage Equity Optimizer is to, if you qualify for a home equity line of credit, right, take the entire amount of the line of credit and apply it towards your mortgage. Now, of course, as the months go on, you have to, of course, continue to pay your regular mortgage monthly payment, but you also want to try and accelerate paying off your HELOC if you financially can do that. What that's going to do, one, is obviously if you're applying $20,000, $30,000 from your line of credit to your mortgage, you're cutting deep into the interest that you would be paying the bank over the 30 years or the 20 years or whatever the case may be. So what happens is you continue to pay your mortgage, you accelerate paying off your HELOC, and then you repeat that process 5 or 6 times until your mortgage is paid for, right? And if we look at the importance of that, any realtor, I can't remember if we have any realtors here, but any realtors or mortgage loan officers, they'll tell you, we'll pretty much cap you out at 28% of your income on your mortgage as far as what you can afford. But what they do is they apply that towards your gross. No one in here lives on gross, we all live on net, right? So if you really apply that 28% to your net, it's really not 28%, it actually becomes like 35, closer to 40%, right? So basically what that philosophy with the Equity Optimizer does is it frees up in 5 to 7 years 40% of what you earn. Now, who can't have a better life off 40% of what they earn, right? So again, these are different ideas that I try to bring to the table. Life insurance. I offer life insurance. I know there's some other life insurance advisors in here. I love life insurance. I own it. I love to sell it. Any insurance company, they are here to protect us, to help you protect your families. But one of the services that they don't talk about, of course, is life settlement options or strategies. Basically where you can sell your life insurance. Now, I'll be honest, this is a new concept to me. I learned about this actually with a guest I was talking to on my podcast. I was a hard sell on that one as well. I looked into it and I actually have sold it and helped several households with it. So basically what it means is this, and I'm not advocating that you run out and go sell your life insurance policy, right? This is in situations where you have a policy, you're thinking about letting it lapse. Let's just say your beneficiaries are financially well off, they don't necessarily need a life insurance. Let's say you're a business owner, you have a key man policy, you guys are maybe going to retire, sell the business, whatever. It's just not needed. If said individual is planning on letting that life insurance policy lapse, as long as it's a permanent policy, whole life or universal life, or it's a term policy that can be converted either partially or entirely to whole life at some point in time, then it's marketable to sell. There's a market where essentially you can approach a life insurance settlement broker. They will go out and say, okay, Darren has a term policy, $200,000. He has, 8 years left on that policy. We can convert it. We'll offer him $10,000 for his policy. I'm throwing that out there, by the way. We'll offer him $10,000 for his life insurance policy. Now, the beneficiary switches from his wife, kids, whoever he had on there now, to the beneficiary now becomes that broker. They give him a check for $10,000. Darren was going to let it lapse anyway, so why not get some of the money back that he had paid over the 20, 30 years, whatever the case may be, for that policy. Again, these are ideas.
Who would continue to pay the premiums on that, though?
I'm sorry?
Who would pay the premiums on that?
They do.
Oh, right.
They do, yeah. You're done. They give you a $10,000 check and hands wiped away. Now, in a real life situation, I had actually written an annuity for this couple. They had really gotten the short end of the stick with a agent that they had worked with back home in Wisconsin. They had a small whole life insurance policy, thank you, and a larger term policy, but their kids are older. They allowed their whole life policy to go away because they quit paying on it. Cash value just kept the policy alive for as long as it could, and all they had was term. And then now they look up and crap, they're only 64, 65 years old. Now they don't have any term. What are they going to do? They did have, luckily, just a little bit of time left on their policy where it could convert, because the conversion ability doesn't necessarily last the entire length of the policy. And it wasn't $10,000, but in their case, it was about $5,000. So, $5,000, I mean, when you're going to let it lapse and evaporate anyway, hey, $5,000 is $5,000. So again, it is a concept or strategy that was new to me. I've been selling life insurance back home in Indiana and here in Arizona for 12, 13 years, and I had never heard of it until I interviewed this gentleman. Looked into it, and I do add it to my arsenal. So again, this is just some things that I try to find different ways to help people. There's some great financial companies out there. We have representatives here with them today, but again, the reason why I went independent was to really be able to fill in some of the holes that I felt that major corporations are not providing. Again, my name is Jamin Armstead, owner of Jamin Financial and podcast host of Everything Cha-Ching.
You still got 90 seconds left, man.
Any questions?
What face value of a policy and cashing it out early? What is the percentage they keep? So if I have a $100,000 policy and I want to sell it, what am I going to get for it?
It depends, because what they're going to do is it's just like when you first got the policy, they're going to actually underwrite you, because they're going to know how close are you to death, basically. I don't mean to be blunt, but that's exactly. Yeah, no, they want to know how close you are to death, and quite honestly, the closer you are to death, so let's say that you acquired a health, situation while you had this policy. Let's say you have stage 3 cancer of some sort, right? You would actually get more than if you were that same age and healthy for that same policy.
Because they're going to cash it in quicker?
Yes.
Okay.
Yes.
So
You're actually going to save them money.
Gotcha, okay.
So yeah, in the long term, because they don't have to pay the premiums, right?
So
So yeah,
It's a math issue.
it is. It just depends. It depends on the conditions, just like when you go through underwriting in the beginning of the process.
Okay.
Any other questions?
That's cool.
No, you guys are easy. All right, I thank you. Appreciate it. Oh, you have a question?
So my husband just turned 70,
Yep.
and he's still working. He
Mhm.
wants to work 2 more years.
Mhm.
And when he quits that job or retires from that job, his life insurance will go away.
Yes.
So could he sell it right before he?
Well, the insurance that he
quits, or how
has,
does that work?
well, the insurance that you're talking about, is it group insurance? Is it attached to his employer?
Yes.
Okay. So he's not able to sell that because that's not a personal policy that he owns. It's part of the benefits package of the employer. But there are a couple options. I would highly recommend sitting down with, an individual such as myself or someone here and talk about a sort of policy that he could have before he leaves, right? Or he could actually convert part of that policy, the group, into a personal policy. That's an option as well. He would have to go through underwriting either way, but before he retires, you want to make sure that he has coverage of some sort. So, yeah, good question. Any other questions?
Good job, David.
All right, thank you.